Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market update for Friday, May 31st, 2019. Interesting day in the markets. I was looking for and leaning towards an upside gap, and we got the opposite. I was, looking for a possible tweet and figured it was about time for Trump to come out and pump the markets with one of his infamous tweets, and we got one, but it went the other way, imposing tariffs on Mexico or threatening to impose tariffs. So we gapped down, and what we did technically, SPY lost the 200-day moving average, but in the video I did earlier today for members, I focused on, the 200-day exponential moving average is the one I like to use. I'll also put up the 200-day simple moving average as well, but QQQ continues to be, although it's not as diversified as the S&P 500, it continues to be the index that I'm looking at the most, because it's those market-leading FANG stocks and tech stocks that took us down. That was what led the market up. That's what broke down. When tech broke, they broke down, and so right now it's all about the FANG stocks, and QQQ does a pretty good job, as and XLK and Apple. This 200-day exponential moving average. In fact, just to recap it quickly, in the video I shared earlier today, for members of the site, I showed you there are corrections and bear markets, and during a bear market you want to look, or a major correction, you want to look for pullbacks, bounce backs into that, the 200-day. Now what we're looking at here real quickly is a 40-week exponential moving average. There's 5 days in a week, in a trading week that is, so if you divide 200 by 5, you get 40. So on a weekly chart, you put up a 40 EMA, and it gives you your 200-day EMA. And you can see it does a great job, just a phenomenal job during uptrends. Here's a little intra-week break, but we still held it, and so unless you get in one of these big corrections, and that's certainly possible. That's what we have to watch for here. But usually after we haven't visited that level in a while, normally you will bounce. Back here we tagged it, and that was pretty close, and the market was weak, and then it went down through there. But once you get trending again, just look at all the reactions there. Look how beautiful. I'll zoom in for you guys here. Let me park this up here, get out of the way, give you a full-size chart to see. And again, so it's just one of many things, but it is a key support level, and like I said, it works very well on the NASDAQ 100. Now back here, if you recall, and I did check the charts, I said to members in the other video, at that time I was not looking for a bouncer. In fact, we had just shorted. We had just gone short, and I was expecting us to continue down through there and looked for bounces back to short, expecting more downside. This time around, we closed below it by a slight amount, a slight close below, and it may or may not come into play next week. I just wanted to point it out because it's not, you don't see it on my daily charts when I go through those levels here. I had 150, 175.66 give or take support, and that was taken out today. So on one hand, we still have the RSI divergences, but no PPO divergence at this point in time, and ugly all around day. I'm going to tell you real quick what I do, because I usually tell you my thoughts, where I'm positioning. I went home in the trading account, flat the indexes. We're still, I'm still trading commodities. We had our, sugar, what was it? Not sugar, coffee hit our one of our price targets today, and that's still a long trade. Wheat, so we're and that's where, those are core holdings as well, and my longer term swing accounts, as well as a trading account. And as far as the indexes, that's it. I think, here's what I think. I think we'll get another tweet over the weekend. We all know that the president hates the market going down. He likes to use the stock market as a barometer for his job in office. So I would put very, very good odds you're going to get a tweet out of DC or from Trump over the weekend, a bullish tweet with some kind of good news on whether it's Chinese or Mexican tariffs, and that could gap the market up. However, it's not worth it to me, because what happened today was ugly. Not ugly because it was down. The market was down. Qs were down 1.6%. You can see there. SPY was down a little less, 1.3. So we're not in the waterfall type selling that we were back last quarter. It's more of just a persistent, move down so far. So on face value, it didn't look bad. I'll tell you why I don't like it and why I don't care to be going home long this weekend. And that is, let me show you real quick, largely due to this, crude oil. Crude is in free fall. We shorted crude not far off the highs. We closed it out. I was looking for a major trend reversal, but what's going on now, just like the markets, I expected a bounce before. It didn't materialize. Not only did it not materialize, this is where I think we closed out here. We had some consolidation and another big impulsive move down. These are crude futures, by the way, we're looking at. Look at that, down almost 6%, 5.69% right here in the bottom corner. That's a big drop in crude. Why does that concern me? Well, crude has been an extremely highly correlated trade for many months, going back well into 2018. Just overlay a chart of crude oil in the stock market. So they're paired trades. The same folks for the most part that are bullish on equities are bullish on long crude. Institutions I'm referring to, and individuals. This concerns me because this, as well as the stocks continuing to fall, increases the odds. I've done videos in the past, going back last year, then to last quarter, and earlier this year, I pointed out we have a margin bubble. We have a margin bubble much larger than the one leading up to the highs back in the market top in 2007. Extreme amount of margin debt. And what that means is, traders, individuals, and institutions, they can buy more stocks than you have money for. You have 100 grand, million, whatever you have to invest, go to your broker and they'll turn around and let you buy a lot more stock on margin, and it juices your gains up, and that's what's big driver of a bull market, and it's also a signature. This is nothing new. Go back in history, all the tops of the bull market, that's when margin interest is usually at a peak, and it tells you if margin interest is at a peak and the stock market's at all-time high, then those aren't shorts loading up on margin. Those are longs that are been doing well, and hey, if I'm making X% a year on Apple and QQQ and whatever else, why not make X times 2 or whatever? And so that's what margin is, but it goes the other way, unfortunately. And when things go down, you get a margin call from your broker, and then forced selling comes. So I don't like to see this in crude. This is not good for the stock market because, again, even if you're saying, well, what does crude have to do with that? Again, these folks, if you have, you're long crude and you're long equities, and there's a good chance a lot of these traders and investors were long both, you get a margin call, you have to sell whatever it is. If you don't sell it, your broker is going to sell it, and sometimes people won't want to sell their crude when it's down 6%, so they'll go ahead and sell Apple or whatever else it is. So anyway, that's one thing that I'm concerned with. The other was Treasury bonds. I've been throughout since last year bullish and long, just until recently hit this upside target that I had here, the 128.55 level, and really I was looking at this scenario on the weekly chart. I have to fix that. Okay, you might not have seen a lot of this on the public YouTube videos because we have trade ideas on this, official and unofficial, for since most of last year. And so the scenario was this. Let me just point it out here. You can see the lines, but let me just change color on this trend line here and show you. So you have this big primary uptrend line right there, and you have, I look for these, and this is a weekly chart, these divergent highs. Look for those for trend reversals. So you had big corrections off both divergent highs. This correction here went all the way down to this low, and that ended with a nice divergent low. So there were, longer term, that's bearish. You had that breakdown, but we had this big bullish falling wedge pattern here on the weekly, and a beautiful divergent low. This is what I like to see. And so that and we had a great entry back here, because what happened is when stocks were going down and we were short, we held off on treasuries. For a while there, treasuries were dropping along with stocks, and I said that is a trend that will not continue. You will get money flowing into treasuries for two reasons: a flight to safety, number one, and also diminish expectations of rate hikes to eventually rate cuts. And that's exactly what happened, because when rates fall, and rates don't have to fall, just the expectation of future rates going down, treasuries will rise, because prices move inversely. So both things happen. It was a perfect storm for treasury bonds, and a heck of a rally since. And here's my point: we hit my target here, 128.56, and/or the uptrend back test. That trend line was my target. Now we overshot it by a hair. And I still think, look, I would put, I don't even put odds, but let's just say 50-50, and that's why I have no position for next week. 50-50 on a rally. I'm going to get to the index charts in a second, whether we rally next week. Again, there's a lot of cross currents, tons of technical damage on the daily and weekly charts, and that's why at best I'm just looking for a counter trend bounce. We're going to get one sooner or later. That's just a given anytime there's a correction. And again, we still have those bullish divergences on the 60-minute charts. They're still well intact. And we have QQQ, as I showed you, right around the 200-day. Both the SMA, simple moving average, and exponential moving average. I'll get back to that in a second. So there's TLT, and it's normal. On any security, I call that a momentum-fueled overshoot. You have a lot of velocity, upward momentum. You may overshoot a resistance level, being a backtest of this trend line, which I can also play around. I could draw the trend line right there, and comes in and actually captures more reactions on that draw. I had it right here before that, so let's just say that's the trend line. Charts are dynamic. I don't mind moving my lines around, and that's what we're looking at there. So I think the risk reward of treasuries is very poor right now. We had a short trade that was stopped out for a minor, 3% loss today. We just shorted 2 days ago, I think it was, and I'm keeping the stops tight on it. That's why. If the markets melt down next week, if we get some forced selling and we drop much more than where we're at now, another 3, 5, 7, 10% was certainly possible. Treasuries are going to continue to climb as a flight to safety bid, as well as increased expectation the Fed's going to come in and do an emergency rate hike if the markets really start going down, or maybe not an emergency hike, but at least at the next scheduled meeting. So that's that. And I just want to say this kind of plays into my stock market analysis. But if we do rally next week, treasuries are, as you can see here, they're at resistance or close enough. And we're also, if you look down here on the RSI, this is 10 years, a decade right here. I'm going to circle every reading. I'm not going to skip every overbought reading. And that is so far, what is that? 1, 2, 3, 4, 5, 6, including this current one. Now, before I get over into the price, let me say this. Overbought can and often does become more overbought. We were overbought here. We continued up. We went, for a few more weeks. Here, it was maybe a couple months of being overbought. So it's not a sell signal in itself, but it is a heads up. You're going to get a correction almost certainly. And again, here's a decade. If you don't, believe me, just look at the facts. The previous 5 readings, I'm going to measure them out for you right here, from high to low. That one was a 20% drop, and that's a big drop in Treasury bonds. There was one right there. I'm going to have to turn these lines off here. Next one was right here. It was very swift and fast. Didn't give people a lot of time to get out. 13% drop, 23% drop right there off that oversold reading, 17% drop. And then if you really took it down to the bottom after that one, that was a 22% drop. So there we are once again for the 6th time in the past decade overbought on Treasury bonds. If I said oversold, I meant to say overbought anytime you cross that red line on the 70s. So we could certainly continue to become more overbought, but the risk reward is very poor right now. So this also factors into my equity market now. So let's say, we are going to get a pullback in treasuries. What's going to cause that? Well, most likely a stock market rally. When the stock market rallies, they come in, whatever the cause is, whether it's purely technical, whether there's some fundamental catalyst, treasuries are most likely going to drop when the stock market rallies. So just keep that in mind. So I'll be looking again to for a short on treasuries. Just have to wait for the next objective entry and stand aside. And again, I just want to see how the markets open next week before doing anything related to this or equities. And finally, gold too. Been bullish on gold. Holding off for an official. I'm looking for a major trend trade to position certain things I'm looking for. I shared that with members in the video earlier today, and I've been covering gold quite a bit lately. But big update in gold. That's a big move, 1.35%. So my point is, I just went over. Okay, I didn't like the drop in the stock market, although it's not that impulsive, like we don't have that capitulation or meltdown selling or anything like that. But what I didn't like today is this very strong bid in gold, treasuries. Those are the two king of flight to safety assets right there. They are undisputed heavyweights. When there's market volatility, when the institutions and the smart money is concerned about the stock market, they want to hedge up, take their money out, or put in something safe. They buy treasuries, and individuals and institutions will also flock into gold. So the fact I'm seeing such a strong rally in gold and treasuries today, and that meltdown in crude oil, not good. I don't like it. So again, if the market can somehow bounce next week, let's get to the charts now on that. We'll wrap this up. Go back to QQQ. Let's go back down to that 60-minute chart I've been living on lately. As I said yesterday, and I've said recently, make no mistake about it. Even though I was, leaning towards a bounce today, a gap out of this wedge. As I said, until it happens, we're in a downtrend, an unmistakable downtrend. There's the wedge. And all we did is made another leg down, just as I said. It was, very possible. I had the wedge line here yesterday, and all we do is just extend it there. The divergences are still very much intact, and this is why, although there is a risk of a sudden swoon down in the market if we start getting hit with margin calls and forced selling, this is just my discipline. This is how I trade. Everyone can do it different. And my trading account, again, not longer term stuff, just my active trading account. I take calculated risks. And I think the risk for especially if there's some kind of tweet or other headline over the weekend that can pop us out of this wedge, and QQQ defends that 200-day moving average. Let me get to that as well for you. Okay. Here's what I was talking about. I always get the question, Randy, why do you use, what do you like, a simple moving average or an exponential? Well, here's my answer. It depends on the security, but I'm also aware whether I think the 200-day SMA or EMA is better. It doesn't matter, because I know a lot of traders use simple moving averages and a lot of traders use exponential moving averages. So I look at both, and right now we have both pinching together. So we have QQQ for the first time since it took out. You can see here and see how they both, traders will react on both of them. But again, the SMA, the red line's my preference. They took it out here and they came in, they back tested again, and then we went. So it was resistance before, and when we took it out, we traded above it. You can also see that in the initial run right into the simple moving average, that purple line above, we had two failures there. And another failure there, pulled back, danced on it for a little while, broke above it, and then look, it acted as support on all these pullbacks. One little washout move there, but then boom. So anyways, whether they play out or not, I just want to mention those are support levels the algos come in and buy at, the program trading investors, institutions, but it's not to say that it can't go. Right here, what happened, we broke it one day briefly, it closed right around on it and bounced off it, and then it went. So I've made it clear. I think there's more downside to come. To me, it's just a matter of, do we bounce first and then go down, or just waterfall solve? So there it is. I just wanted to point out those levels. And then back to that 60-minute chart of QQQ. There it is. We're just wedging down. The divergences are still very much intact. We can look at NQ, NASDAQ 100 futures. Same thing. Here's your wedge. Here's your two, both downtrend lines. I have alternative draws. You want to wait for the two to break. So I'll watch this. I'll pick this up on Sunday night, see what the futures do. The thing about heading into a weekend, today's Friday, you have 2 extra nights of overnight risk. And I talk about how I like the futures because I can manage my trades and have some tight stops or stops wherever I want them to be, and have those stops taken out at 3 in the morning if I'm deep asleep. If the security, the futures I'm trading go through. That happened to me last night. It happened after Trump's tweet. That's a good thing. But those don't work on the weekends because the futures have now stopped trading and they won't pick up again till Sunday evening. So Sunday evening I'll pick this up and get back in, depending if I see a good entry, long or short. But that's what it looks like. And again, the point I'm trying to impress is there's cross currents here. The weekly, the daily, the long-term charts look very ugly, and I have a even a higher degree of confidence now than a couple weeks ago that we're going to go lower. But it's a matter of getting caught in one of these kickback rallies, and you don't want to be short on those. Again, active trading stuff. Swing trading, made it very clear. If you've got some core short holdings, tuck them away. At most, at this point, yesterday I said maybe a 2 to 3% rally. So now we dropped another percent. What does that bring us up? So now maybe a 4% rally here on the market. This is ES, the S&P 500. So, anywhere from, we'll say now a 3 to 4% rally if we get it. But my confidence isn't that high to play it. So we'll just wait and see what happens next week. I think that's it. Those are the main things I wanted to talk about. So like I said, some cross currents, and then finally the whole rubber band analogy. I used that in the video earlier today. The markets are like a rubber band. The rubber band gets stretched to the downside. The more it stretches, the more it's going to snap back. Back then in fourth quarter, that first rally was over 6% counter trend rally. This one was 10%, and this snapback rally was 10% as well. So just try to imagine what that would do if you're very short. So right now, while the risk of a sudden swoon down is certainly there, the reward is not worth it, or the risk of being caught in a sudden snapback rally. Again, you can manage stops, at least during the week with futures, but on stocks, you can gap up right here. There's a gap right there on that move up, and that was almost a 2% gap. And I've seen gaps in either direction that exceed 3%. So that's what you could be looking at. And again, better in my opinion, even if there's more downside, to just wait for the next kickback. Let's say we take out that 200-day and some of these resistance levels that I had overhead. We come down here to my next target around on QQQ, which is around 171.15 to 171.63. So call that about 171.50ish, maybe down to 171. A little more downside there. It's pretty decent support, and we get that, and then maybe we look to start shorting kickback rallies. But like I said, I'd prefer to see it would mesh well to see that bounce next week, because it's still very much priced into the 60-minute charts, and the fact that we're at the some of these support levels here on the daily. And so look for maybe a bounce next week if we get it to if it starts to materialize early enough without too big of a gap on Monday, maybe jump in and trade it. Otherwise, just look to layer back into some of the shorts that we closed out recently on the site on that bounce back. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.